Deductibility of interest expenditure on loans from related parties under UAE Corporate Tax Law. The UAE Corporate Tax Law outlines specific restrictions on the deductibility of interest expenditure when it is incurred on loans obtained from related parties, especially in relation to certain types of transactions. This provision is intended to prevent potential abuse by taxable persons who engage in arrangements that erode the tax base through related party interest deductions, while allowing income derived from these transactions to benefit from corporate tax exemptions. Interest expenditure restrictions on loans from related parties. Under the Corporate Tax Law, interest expenditure on loans obtained directly or indirectly from a related party is not deductible if it relates to any of the following transactions. Dividend or profit distribution to a related party. If a loan is used to finance the payment of a dividend or profit distribution to a related party, any interest incurred on such a loan is disallowed for deduction purposes. Redemption, repurchase, reduction, or return of share capital to a related party. When a loan is utilized for the purposes of redeeming, repurchasing, or returning share capital to a related party, the related interest expenditure is not deductible. Capital contribution to a related party. Any interest on a loan taken to make a capital contribution to a related party is not allowed as a deduction. Acquisition of ownership interest in a business that becomes a related party. Interest incurred on a loan used for acquiring an ownership interest in a business that either is or subsequently becomes a related party is similarly disallowed for deduction. Purpose of the provision. The primary purpose of this restriction is to prevent situations where taxable entities engage in transactions with their related parties for the main purpose of creating deductible interest expenditure that would reduce their taxable income while ensuring that the corresponding income from the transaction is either exempt from or benefits from a reduced corporate tax liability. By disallowing such interest deductions, the Corporate Tax Law aims to preserve the integrity of the tax base and curb tax avoidance strategies involving related party financing arrangements. Exception: demonstration of genuine commercial purpose. While the general rule is to disallow interest deductions related to the above transactions, the deduction restriction does not apply if the taxable person can demonstrate that the main purpose of obtaining the loan and carrying out the transaction was not to achieve a corporate tax advantage. Determining whether a genuine commercial purpose exists will depend on the specific facts and circumstances surrounding each transaction. Additionally, if it can be demonstrated that the related party receiving the interest is subject to corporate tax or a similar tax in a foreign country at a rate of at least 9% on the interest income, then the transaction will not be considered to have a corporate tax advantage. As a result, the interest expenditure would be deductible. Example of interest expenditure restriction: MLLC case study. Background information. MLLC is a UAE resident company engaged in global hotel operations and is wholly owned by P Ltd, a foreign entity registered in Country A. During the tax period ending December 2026, MLLC engaged in two separate borrowing transactions. 1. Loan from an unrelated commercial lender. MLLC borrowed funds to complete the construction of a new hotel complex and paid AED 14 million in interest for the tax period. 2. Loan from Q LLC. MLLC also borrowed funds from Q LLC, a related party, wholly owned by P Ltd, registered in Country B, at a higher interest rate compared to the unrelated lender. MLLC paid AED 4 million in interest on this loan, which was used to finance a dividend payment to P Ltd. Key details. EBITDA for MLLC for the tax period ending December 2026, AED 55 million. Total interest expenditure for the tax period, AED 18 million, including AED 4 million paid to Q LLC. Net interest expenditure carried forward from the previous tax period ending December 2025, AED 7,500,000. Q LLC, the related party, is not subject to corporate tax or a similar tax on the interest income it receives. Analysis of deductibility. Determining maximum deductible interest. Under the corporate tax law rules for interest expenditure deductions, MLLC's net interest expenditure is subject to a cap based on the greater of 1. 30% of EBITDA, calculated as 30% of AED 55 million, which equals AED 16,500,000. 2. De minimis threshold of AED 12 million. Since AED 16,500,000 is greater, this is the maximum allowable deduction for MLLC's net interest expenditure in the tax period ending December 2026. Exclusion of disallowable expenditure. When calculating net interest expenditure, any disallowable interest must be excluded. In this case, the interest paid on the loan from Q LLC, related party, to finance the dividend payment to P Ltd must be excluded, as it is automatically disallowed under Article 31 of the Corporate Tax Law unless MLLC can prove that the main purpose of the loan was not to achieve a corporate tax advantage. Given that the loan was not obtained on an arm's length basis and was used solely to finance a dividend payment, this interest expenditure is disallowed. Net interest expenditure calculation. Total interest expenditure, AED 18 million. Disallowed interest from Q LLC loan, AED 4 million. Net interest expenditure for the tax period, AED 14 million, AED 18 million, AED 4 million. Since the net interest expenditure of AED 14 million is below the maximum allowable deduction of AED 16,500,000, MLLC can also utilize AED 2,500,000 of its carried forward net interest expenditure from the previous year. This leaves AED 5 million, AED 7,500,000, AED 2,500,000 to be carried forward to subsequent tax periods, subject to the interest capping rules. Taxable income calculation impact. Total deductible interest, AED 16,500,000, maximum allowable amount. Net interest expenditure utilized, AED 14 million. Additional carried forward deduction, AED 2,500,000. Remaining carried forward net interest expenditure, AED 5 million. The disallowed AED 4 million, interest paid to Q LLC, must be adjusted for in MLLC's taxable income calculation, as it cannot be claimed for corporate tax purposes.